Just invest in the S&P 500 can already. I hear this all the time and honestly, it's not bad advice. Simple, it's passive, he has made investors an annual average return of more than 10% over the past century. But what if I told you that just blindly investing the S&P 500 could actually be costing you money? What if you're losing thousands of dollars in hidden taxes and forex risk? What if history shows that entire decades have passed where S&P 500 investors made nothing? Because here's the thing, this advice works perfectly for US investors, but for Singaporeans, it's a different game. In this video, I'll break down 5 hidden risks that could quietly be eating away at your returns and what you can do to fix them. Before we dive right in, remember to hit the like and subscribe button, it helps this channel a ton. Many Singaporean investors unknowingly lose hundreds of thousands of dollars over their lifetime just because of this one thing: dividend withholding tax. If you're investing in a US domiciled fund like a SPY or a VOO, every dividend payout you receive is automatically taxed 30% by the US government before you even see a single cent. Let's break this down with real numbers so you can see just how this tax is quietly eating into your returns. The S&P 500 has an average dividend yield of about 1.3% per year. US investors get to keep 100% of their dividends. But as a Singaporean investor, if you're investing in US domiciled funds, you only receive about 0.91% after that 30% tax is deducted. That's nearly a third of your dividends gone just like that. And because dividends get reinvested, this isn't just money lost today, it's compounding potential lost forever. Now let's see what happens if you invest $1,000 every month for 30 years and reinvest the dividends while losing 30% to taxes every single time. Using a 10% annualized net growth rate and a 1.3% dividend yield reinvested, you can see that when compounded over 30 years compared to a fund with no dividend withholding tax, US domiciled funds investors lose almost $200,000 to tax inefficiencies as a Singaporean. But what if I told you that you didn't actually need to pay that 30% tax? There is a way to legally reduce it without changing your investment strategy. The solution: Ireland domiciled funds. These funds are structured under the Irish tax law, which has a tax treaty with the US to reduce dividend withholding tax from 30% down to 15%. This means instead of losing nearly a third of your dividends, you keep more. And that extra compounding power helps your portfolio to grow significantly over time. And the best part is that there are Ireland domiciled funds that track the S&P 500 just like S&P or VOO. Let's now compare what happens when you switch from a 30% tax fund to a 15% tax fund. By simply switching to an Ireland domiciled fund, you will have an extra $100,000 after 30 years without doing anything differently. Same S&P 500 exposure, lower tax, bigger returns. Many Singaporeans invest in the S&P 500 thinking that they're making 10% per year. But what if I told you that the real returns could be far lower once you convert back to SGD? If the USD weakens against SGD, your portfolio might not be worth as much as you think. And this isn't just theory, it's already happened before. In January 2002, the USD to SGD exchange rate was about 1.83. That means 100,000 US dollar was worth about 183,000 Sing dollars. From 2002 to 2011, the S&P 500 grew by 28%, bringing the portfolio to 128,000 US dollars. You're thinking, great, I made money. But by December 2011, the USD has weakened against the Singapore dollars. The exchange rate dropped to about 1.29. So now when you convert your 128 thousand dollars back to Singapore dollars, you only get back about 165,000 Sing dollars instead of the expected 235,000 Sing dollars if the exchange rate had remained stable. You lost 29% due to forex fluctuations, and your net loss in the end became $18,000 Singapore dollars. Even though the S&P 500 grew by 28% over this period, you actually lost money in SGD terms. You thought you made 28% in USD, but in SGD terms, you actually lost 9.86% over 9 years. And if you account for inflation, it's even worse. And here's the thing, this wasn't just about the currency fluctuations. It was also because from 2002 to 2011, it was one of the worst decades for the US stock market growth in history. This period is often referred to as the lost decade, which I will explain deeper in risk number 5. So make sure to keep on watching. So even if the S&P 500 performs well, a weakening US dollar means your returns in your SGD shrinks. If SGD strengthens against US dollars, your future withdrawals could be worth less than expected. So if you retire in Singapore but your investments are in USD, you could drain your retirement capital funds without even realizing it. So the biggest question is, could it happen again? Looking at the historical exchange rate data in the chart, we can see a clear long-term trend. The SGD has significantly strengthened against the USD over the decades. During the 1980s, it was at about $2.20 SGD. By the 1990s, it was around $1.60. Today, the USD to SGD exchange rate fluctuates between 1.3 and 1.4. That means that over the last 45 years, the USD has consistently weakened against the SGD, by 38%. If history repeats itself and the USD continues strengthening, a Singaporean investor holding a 100% USD denominated portfolio face a major risk of losing at least a third of their retirement portfolio just to currency risk. So how do you protect yourself from the potential long-term USD weakening? Since there is no SGD denominated S&P 500 funds, Singaporean investors must accept that currency fluctuation will always be a factor when investing in USD-based assets. The simplest way to mitigate currency risk is through global diversification, investing in stocks or funds that hold assets in different currencies, not just USD. If you're a retiree and you plan to retire in Singapore and will be spending in SGD, it makes more sense to keep the bulk of your investment in SGD-denominated assets as compared to exposing to yourself to currency risk. The bottom line is, if the long-term trend suggests that SGD is likely to continue strengthening, which makes it risky to hold 100% of your portfolio in USD, smart investors will hedge their bets. Most investors focus on growing their wealth, but very few think about what happens to their investments when they pass away. If you hold US domiciled funds like VOOs or SPY, or if you own individual US stocks, your portfolio could be hit with a massive 40% estate tax before your beneficiaries even see a single cent. Before we continue, I want to make something very clear. This is not estate planning or tax advice. If you have deeper questions about this area, please ask your respective advisors. That being said, here's what I know and what you can do to protect your wealth. If you are a US citizen, estate tax only applies to wealth above $13.6 million. But for non-US investors, including Singaporeans like you and I, the exemption is just $60,000 US. So let's assume you build a portfolio of $1 million US with a combination of US funds, US stocks, and even cash parked in a US broker like Interactive Broker. If something happens to you, here's what your beneficiaries will face. If you have a $1 million USD portfolio, your family could lose up to $322,400 to US estate tax. So how do you protect your wealth and ensure your family gets the full value of your investments? Yeah, 3 simple strategies you can use. Number 1, invest in an Ireland domiciled fund instead of US domiciled funds. Not only does Ireland has a tax treaty with the US reducing dividend withholding tax from 30% to 15%, but they are also not subjected to US estate tax. Number 2, invest in funds through a 101 investment linked policy. One of the most overlooked ways to legally avoid US estate tax is by investing in US funds through a 101 investment linked policy. Upon your passing, 101% of your policy value, some even 105%, is paid out to your beneficiary, typically without US estate tax implications. When you buy an ILP, the legal owner of the underlying investments is not you, it's the insurance company. You are simply a policy holder owning units of the ILP, not the US stocks or funds directly. When you pass away, the ILP pays out a death benefit to your beneficiaries without triggering US estate tax. If you invested $1 million US into a US fund directly under your name, if you pass away, your beneficiaries could face up to 40% estate tax, losing $332,000 US to the IRS. If instead of investing directly, you held the same funds inside an ILP, upon your passing, your beneficiaries receive the payout tax-free instead of dealing with US estate tax headaches. Now hold up, before you go out and buy just any ILP, let's be clear. Not all ILPs are structured in a way that makes financial sense. A lot of ILPs comes with high fees. If you're investing for returns, you should only choose pure investment ILPs where the insurance and the investments are separated. And if you're looking for a 101 ILP, it should be a low break-even yield ILP so that it doesn't necessarily eat into your gains. Number 3, you could buy life insurance to cover potential estate liabilities for your US individual stocks. If you prefer owning individual US stocks directly, whether it's Apple, Nvidia, or Tesla, you cannot fully escape the US estate tax exposure. But what you can do is to plan for it so that your beneficiaries don't have to sell off your stocks just to pay taxes. And the simplest way to do that, life insurance. Let's say you build a $1 million USD portfolio of individual US stocks. If something happens to you, your beneficiaries could owe up to $332,000 in US estate tax. Without proper planning, they may have to sell off your shares, possibly at a loss, just to pay the tax bill. Worse off if it's a bad time to sell off those shares. But what if instead of forcing them to sell those assets at potentially the wrong time, you had a life insurance payout ready to cover it? You estimate your estate tax liability based on your portfolio size. You purchase a term or whole life insurance policy with a sum assured equal to the estimated estate tax bill. Upon your passing, the life insurance payout covers the taxes, so your beneficiaries keeps 100% of your stock portfolio intact. So for example, if you see yourself holding US stocks from age 30 to 60 years old, for example, you can buy an extra term insurance for that term period to protect any asset liabilities. For wealthier investors with large US holdings, there are more advanced ways to structure your investments, like setting up a non-US corporate entity to hold US stocks or using a trust structure to protect your assets. I'm not going to go into this because I've never done that myself before, but if you have any experience with these strategies, please let me know. I'd love to learn how they work. For the past 10 to 15 years, the US stock market has been the best place to invest. The S&P 500 delivered more than 13% annualized return from 2010 to 2025. Big tech like Apple, Microsoft, Nvidia, Amazon, Meta skyrocketed in value. The US became the global leader in AI, cloud computing, and software. And to be honest, I personally invest majority of my money in the US stock market because I see the innovation, the strong capital markets, and the technology leadership. But if there's one thing I learned as an investor is that we can't assume what always worked in the past will always work in the future. So I constantly challenge my own thinking because I learned that the best investors don't just follow what's popular, they ask, what if I'm wrong? Today, the US has been dominant, but if history tells us anything, is that leadership in the stock market rotates. A lot of Singaporeans invest in the US simply because that's where all the attention is. We are unconsciously making a massive assumption that the US will always be the best place to invest. And I completely understand why. The biggest YouTube finance channels, mainstream financial medias like CNBC, Bloomberg, they all primarily focus on the US markets. When was the last time you saw someone talk about Japan, India, or emerging markets? It's not that opportunities don't exist outside of US, it's just that we don't hear about them as much. Most of us assume that US has always been the best place to invest. But if you look at history, that's actually the exception, not the rule. Look at the 1970s, 1980s, and 2000s. The US was not the best place to invest. In the 1970s and 1980s, Japan's stock market delivered over 20% annualized return, crushing the S&P 500. In the 2000s, the US stock market lost money for an entire decade, while emerging markets gained nearly 15% per year. If you're investing in the 2000s and only held the S&P 500, you made nothing for 10 years. Meanwhile, investors in China, investors in emerging markets nearly tripled their money. So as much as I like investing in the US stock market, we have to acknowledge that leadership changes over time. In every decade, a different region has taken the lead. Japan dominated 1970s and 1980s. Emerging markets dominated the 2000s, and the US market is dominating the 2010s. The question is, will the next decade still belong to the US, or will it be India, Southeast Asia, or another region's turn? If you're 100% invested in the S&P 500, you're making a big bet that history won't repeat itself. I'm not saying that US is going to collapse. I personally hold primarily US stocks and funds myself. What I'm saying is that as investors, we need to think on another level. We need to question our assumptions. We need to look at both sides of the thesis. We need to be objective and rational in how we structure our portfolio. Because if history tells us anything, is that no single stock market leads forever. And it is not just invest in S&P 500 can already. A lot of investors also assume that because the S&P 500 has 500 stocks, it's well diversified. But here's the reality. The top 7 stocks makes up nearly 30% of the index. This means that when you invest in the S&P 500, you're not making a bet on the US. You're making a concentrated bet on a handful of tech stocks. If these companies underperform, the entire S&P 500 suffers. This happened before with Japan in the 1980s. It was the world's biggest stock market, but after its tech and financial sector collapsed, Japan's market only recovered 30 years later. And look, I own US tech stocks. I believe in the 6th wave of innovation and artificial intelligence, but we have to acknowledge the risk. One of the biggest assumptions people make when investing in the S&P 500 is, as long as I hold long enough, I will always make money. And historically, the US stock market has delivered strong long-term returns. But what if I told you that there was an entire decade when S&P 500 investors made nothing? Yes, from 2000 to 2010, the S&P 500 delivered an annualized return of minus 0.9%, meaning for 10 straight years, investors earned zero growth. And this is not accounting for inflation. This is what we call a lost decade. So the key question is, could it happen again? Let's break it down. In the late 1990s, the US stock market boomed. The dot-com bubble drove stock prices to unsustainable levels. The S&P 500 hit a record high in the early 2000s, then it all crashed. The dot-com bubble burst, wiped out 50% of the US stock market value. Then the S&P 500 took 7 years to recover to its previous high. Just when it was recovering, the 2008 financial crisis happened. The market crashed again and the S&P 500 fell another 50% from 2007 to 2009. Investors who solely focused on the S&P 500 for that 10 years made nothing. Meanwhile, investors in emerging markets tripled their money. The key lesson is this: if you were globally diversified, you wouldn't need to suffer through that lost decade. Could this happen again? Who knows? A lost decade happens when the market is overvalued and the major economic shocks occur. The facts are that the US stock market today has similar red flags to the year 2000. The S&P 500 is trading at a forward PE of 24 times, exactly the same right before the lost decade, and the S&P 500 is dominated by a handful of mega cap tech stocks, just like in the dot-com bubble. This doesn't guarantee another lost decade, but it increases the risk. All in all, I'm not here to tell you that the S&P 500 is bad, because at the end of the day, investing is about following what's easy. It's about structuring a portfolio in the smartest way possible. So the next time someone tells you, just invest in S&P 500 can already, I hope you pause and ask yourself, is that really the best decision for me as a Singaporean investor? Am I optimizing my portfolio for my goals and time horizon, or am I just following what mass majorities or what US investors are doing? The S&P 500 is a great tool, but it's not the only tool. If you want to structure your portfolio for maximum efficiency without paying over taxes or exposing yourself to hidden risks, talk to me. Right, comment down below, what do you think? Is the S&P 500 all that you really need, or do you see the risk now? Let me know your thoughts. Alright, that's all for this week's video. I'll see you on the next one.